Chapter 6, Part 2, we're going to look at absorption versus variable income statement. Cost behavior. We have to remember that this helps a lot when we're looking at or analyzing costs internally. So, how these have to do with how costs change in volume when volume changes. And again, they're variable, fixed, and mixed. Now, again, we'll go over the key characteristics. Variable costs. Total variable costs change in direct proportion to changes in volume, but they stay the same within the relevant range at the same rate. Fixed costs. Total fixed costs remain constant within the relevant range, but have an inverse relationship with changes in production on a per unit basis. So now we're going to look at variable costing and contribution margin, but first we're going to look at absorption costing, which is what we've been looking at so far when we did financial accounting. All manufacturing related costs, fixed and variable, are absorbed into the cost of the product. This is required by GAAP and the IRS for external reporting. Direct material, direct labor, and manufacturing overhead are treated as product costs. Traditional conventional income statement. So again, we have sales, cost of goods sold, then we get our gross margin, then we have a selling, general, administrative expenses, and then operating income. Now let's look at a problem and do it using absorption versus the contribution margin method. So here is our example. The first thing we're going to do is we're going to take this information and we're going to prepare an income statement under absorption costing. Now, this is like your homework. It's a little tricky. So I've tried to explain how to do this as much as possible. So the first thing we're going to do is remember it's units sold times the sales price. It's not units produced. Cost of goods sold. We know the direct cost per unit because they gave you that in the problem. So we know direct material and direct labor, that's $28 times 12,000 units sold. That gives us $336,000. The issue is the manufacturing overhead. We're going to do something we normally wouldn't do, which is we're going to take the total manufacturing cost and divide by the units produced. Remember, it's not sold, it's units produced. And we get $18 per unit, where they're going to take that times the units produced to get our cost of goods sold. And we're going to subtract that and get our gross profit. Then we're going to less variable costs in operations times units sold plus the fixed, and that tells us our net income is $184,000. So what is our product cost? It's going to be the direct materials, direct labor, plus the average overhead, and we get $46. What is ending inventory? It's going to be $46 times 16,000 made minus 12,000 sold, which is $4,000. Cost of goods sold is $552. Net income is $184. Now let's look at variable costing. Now variable costing, we assign only variable manufacturing costs to the product, direct material, direct labor, and variable manufacturing overhead. All fixed costs are treated as a period cost. This is only used for internal management decisions, often leads to better decisions because it shows incremental cost of manufacturing each unit. Operating income will not be affected by changes in inventory levels. So, contribution margin income, the statement characteristics. It's organized by cost behavior. All variable costs are expensed above the contribution margin line. All fixed costs are expensed below the contribution line. Contribution margin equals sales minus variable expenses. Operating income is the same in both statements when all the units that are produced are sold. If they're not, we can do a reconciliation to make sure we did it correctly. Service and merchandising company operating income will always be the same regardless of the format, only for internal use. So we start with sales, we subtract our variable costs, we get our contribution margin, we subtract our fixed costs, and we get our operating income. So now we're looking at the same problem we just went through. So first, we're going to start with our sales revenue. Then we're going to subtract our variable expenses. Now, manufacturing overhead applied, we're going to take our total manufacturing overhead less the fixed portion, which gives us the variable portion, divided by the units produced, tells us it's $4 per unit. Now, to get our total variable per unit, we're going to take our direct materials, direct labor, and variable overhead, and now we have a rate of $32 per unit. So that's how we get our variable cost of goods sold. Then we're going to take our variable operating expenses, and that tells us our contribution margin is $384,000. We're going to subtract all of the fixed costs, and that tells us our operating income is $128,000. Now, it is different than our traditional method, absorption, because we have items left over in inventory. We have those 4,000 units. So we will do a reconciliation, but let's answer the rest of the questions. What is the product cost under variable costing? $32. What is ending inventory? $128. $128,000. What is cost of goods sold? $384. What is net income? Again, because under absorption, we include a portion of the fixed costs and inventory, and we didn't sell all the units we produced, we have a difference. So now we'll take a look at how do you determine, reconcile, make sure you did it correctly. You always want to look at a problem two different ways, particularly when you've got all these estimates and stuff, because it's a good check figure for you. So if you manufacture and do not sell all your inventory, then you will get a different net income under absorption versus contribution margin. The difference in operating income is the change in inventory level in units times the fixed manufacturing overhead per unit. So we had net income under variable costing is 128, plus ending units in inventory is 4,000. The average fixed manufacturing overhead rate is $14. And when we add that to our variable in net income under variable, we get our net income under absorption. Now, absorption costing and manager incentives. When inventories increase, absorption costing income is higher than variable income. When inventories decrease, absorption cost and income is lower than variable income. Therefore, managers may increase production to build up inventory to maximize income and therefore their own bonuses. That ends part 2 of chapter 6. And I'm sorry, but I just like that picture. I thought that's the cutest little doggy. All right, I hope that helps you with your homework.